Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with the sponsors for this segment, Admiral Markets. It gives me great pleasure to reintroduce Mr. Darren Sinden, market commentator for Admiral. Darren, how the devil are you, sir?
Yeah, very well, thank you, Nick.
An amazing end to the week. Non-farm payrolls, an absolute stonking number, and all bets are now on a December rate rise.
Yeah, they are. I actually looked at that today in terms of how big a jump it was against consensus. Funnily enough, if you look at the data back to 2007, it's only just inside the top 20 deviations from consensus. It literally is number 19. So whilst it seems a big jump, you know, to us with
it only hits
short
the top
memories,
20.
Yeah,
right.
Yeah, and that's just on the positive surprises. So, but yeah, of course, no one was calling it, and it came right out of the blue. The Fed fund futures have moved to a 70% probability of a December rate rise, and it'd be very hard, you know, even for a cynic and a bear like me to see past a Fed rate rise in December now. We'll have to wait to the meeting, of course, and we'll see what the next number brings, but end of November, beginning of December, but yeah.
Understood. Okay, so we've got a number of slides to go through. Let's kick off with the first one, data released over the European session. What's caught your attention today?
Okay, well, first item on the agenda was actually released yesterday, balance of trade data for China. You might remember they had a shocker last month, and it wasn't a great deal better. This time round, imports were down about 18.8%. This month, you know, after 20.4% fall last month, and exports also dipped. So negative, but taken in its stride really. Chinese equities didn't react. They focused more on the likelihood of a reintroduction of IPOs in the new year. So, and then we came into Europe and German balance of trade, and that was much more positive, a big beat actually on both the exports and imports and the net figure. So that's a sort of feather in the cap there for the German economy. However, a couple of hours after those German trade numbers, the OECD, the Organisation for Economic Cooperation and Development, produced its most recent annual economic outlook, or update I should say. The main thrust is that the slowdown in global trade poses a threat to the world's developed and emerging economies, and they cut their global growth forecast in 2016 to plus 3.3% from plus 3.6%. They also trimmed the 2015 number for what it's worth, but I think it's, you know, more important to be forward-looking now than worrying about the last month of the year.
Week ahead?
Right, well, reasonable amount of European data. We start tomorrow with the British Retail Consortium retail sales number for October. Obviously, the health of the UK consumer is quite key to maintaining the momentum in the UK economic recovery. Then we have French and Italian industrial output numbers for September. Obviously backward looking, but nonetheless they do give you some flavour of how those two economies are performing. On Wednesday we've got several key data items from China, but urban investment is one that I'll be focusing on, because this is one of the numbers that makes up the basket of economic activity items that people use to try and get a real handle on proper levels of China GDP rather than the headline government figures. And then on Wednesday as well, unemployment here in the UK for September, and obviously we're looking for a further dip in that if you're on the bullish stance of interest rates. Thursday rather, German inflation data for October. Again, it'll be interesting to see what happens there, because, you know, stimulating inflation is one of the key things that the ECB is trying to do. If there isn't any proper inflation proper in even the German economy, then one wonders how they're going to stimulate it in the underperformers within Europe. Understood.
Let's move on to European movers. What's caught your attention this morning?
Well, Intercontinental Hotels, IHG here in London, one we've talked about before on the show, trading around £26.67 shortly before we came on air, down around 3.86%. And the hotel group has said categorically that it's not considering a sale or indeed a merger with another company after press speculation that it was going to do that on Friday. It's an old story that's been trotted out. There are activist investors within Intercontinental and in US hotel groups, and the talk has been, in fact, we've mentioned it here, that there could be a combination, but the IHG management seems to have ruled that out for now, at least.
So Jupiter and Henderson.
Yeah, well, we stay with the sort of press-driven takeover stories. The Sunday Times carried an article that suggested Wells Fargo, which is WFC in the US, is one of America's biggest banks, is considering bidding for a UK fund manager, and that Jupiter or Henderson Group were on the shopping list. So they're both up by well over 3% and enjoying a very positive session. Wells Fargo has had a presence in the fund management market in the past. It once owned what ultimately became Barclays iShares business. So it's no stranger to the fund management sector.
Understood. Let's turn our attention to M&A rumours and movers.
Okay, well, a deal that was announced yesterday, so caught the market slightly on the hop. Weyerhaeuser, which is ticker WY in the States, is to acquire Plum Creek, PCL, and create the world's leading forestry products group. So not perhaps a particularly sexy sector, nonetheless a big market in the US. Plum Creek shareholders are going to receive 1.6 Weyerhaeuser shares for each of their PCL shares, which is approximately a 13.8% premium to the PCL price over the last 30 days. It's not a huge premium, but then these companies are set up as REITs and fairly staid businesses. So, that kind of a move in, or that kind of a premium in that kind of setup, it's actually quite promising. PCL have actually jumped 15.8% pre-market to around $46.65. Weyerhaeuser's not just incentivising PCL shareholders, though, through that takeover. It's going to create a 2.5 billion share buyback fund and do that soon after the deal is closed. And it's also stated that it will maintain its progressive dividend policy as another incentive to PCL shareholders. So quite a lot of sweeteners in there. Just to give people a feel for the size of the combined group, will control 13 million acres of timberland, which is a mind-bogglingly large amount of space, and have a market cap of around $23 billion. And the merger should yield synergies of around $100 million per year annually. In terms of other names in the sector, probably worth keeping an eye on this, because this really does create a category killer if it goes ahead. Ryanair, which is ticker RYN, Universal Forest Products, ticker UFPI, and Deltec Timber, ticker DEL in the US. And now they really will need to consider their strategic options, because they'll be left behind if the deal goes through.
Understood. Let's take a look at the US data points to keep an eye on.
Absolutely nothing on the calendar today of any consequence. And just a quick mention to viewers that we've got Veterans Day on Wednesday, which is a partial US holiday, so markets are open and the banks are shut. But there is something to look forward to. Wholesale trade and import prices tomorrow. We have weekly jobless numbers on Thursday, and obviously on the back of the non-farm payrolls, be interesting to take a look and see what they're telling us, if anything. We also have 3 Federal Reserve governors speaking independently on Thursday, and on Friday we have both producer price index data and retail sales. So it's really loaded towards the back end of the week this week as far as US data is concerned.
Understood. Let's take a look at the US pre-market movers and some chart points.
So in terms of pre-market movers, I'm just really here flagging a couple of stocks which were good markets on Friday, and wondering if that will continue into today's session. So first of all, BlackBerry, that's ticker BBRY, $8.02 they closed on Friday, up around 5.53%. They were better basically because the early reviews for their new Priv phone were positive, and I saw the CEO interviewed a couple of times on TV on Friday, and he, must say, talked a very good game about the company's repositioning, their financial position and where they're headed, which is probably away to some extent from the handset market. So I think that may have a feed into that. And then we spoke about media stocks recently and how they sparked a sell-off in August. We cautioned people to keep an eye on what their numbers were like. Well, Walt Disney, which started that August sell-off, reported on Friday, $115.67 they closed, up around 2.36%. They reported earnings, and interestingly, these are reporting for Q4, so they're a quarter ahead of nearly everybody else in the US. But they reported earnings 6 cents ahead of forecast at $1.20 versus the forecast of $1.14. Revenues were slightly lighter at 13.51 billion versus 13.55. But I think the earnings beat was good enough to see them trade higher, and that may well continue into today's session.
chart points?
Yeah, well, cash equities have all been quite quiet, really, this morning in Europe. So for the FTSE, we've managed to tighten the range now to 63.50 on the downside, plays 63.90 to the upside. For the DAX, 10,940 plays 11,000. It's been some time since we've had
11,000 on the radar.
Well, A, 11,000 on the radar, and B, just a 60-point range, because it's obviously been a very, very volatile beast of late. For the S&P, 2085 to the downside, plays 2105 to the upside, and for the Dow, 17,790 plays 17,920 to the downside. Currency-wise, euro dollar eased again from Friday, so 107.51 on the downside, plays 108.10 to the upside. The Aussie dollar, again, obviously, dollar strength being prevalent after Friday's numbers, has weakened, and so the Aussie dollar now 70.25 on the downside, plays 70.70 to the upside, trying to desperately to hang on to the 70 handle. The yen has weakened, so 123.02 now for the yen against the dollar on the downside, plays 123.76 to the upside, but I suspect the bias is to the upside there. And cable doing its best to hang on to a 150 handle, 150.30 on the downside, plays 150.90 to the upside, but
seller for choice.
yes, exactly.
Okay, let's go to our last slide, the thought provoker in focus. What's in focus today?
Well, really, what we wanted to have a look at here was what the reaction had been to Friday's job data. Bonds have had their move, but equities seem to be hesitant. So the chart here plots the US 10-year note against the S&P 500, the bond in the blue and the index in green. And as we can see, US 10-year bonds have moved, as we might expect them to, in the light of the 70% chance of a December rate rise following Friday's outside payroll gains. And obviously the move has been that bond prices have fallen and yields have risen. US equities, though, have posted a muted response, though it's fair to say that both financials and the regional bank sector have moved higher in the US. So the question is, are US equities pausing for thought, or did October's rally leave little room for upside manoeuvre here? And then further from that, will the benefits of an improving US economy be outweighed by rising interest rates? And that really sort of throws up a question about the pace of any Fed rate rises. Would December be a one-off event, or would we see a rapid escalation? So we need to think about that. In terms of what the market might be thinking, I think it could be very interesting to watch the consumer discretionary sector, because obviously if rates rise, perhaps people's incomes will be pinched. They've got to pay off the debts that they've got, or at least fund them at a higher level. So perhaps watch that sector. XLY in the US is a highly liquid ETF on the consumer discretionary sector, so it may be an idea to keep an eye on that. It's early days. We literally, realistically, not even 36 hours in market terms after the that news on payrolls, and so there's a lot to digest. But there's the gut feeling is that equities shouldn't do so well in a rising interest rate environment.
Understood. Okay, Darren Sinden, market commentator, Admiral Markets. Thank you very much. As always, we'll be back same time on Friday at 1 p.m. That wraps up the Wall Street Crossover Show. Have a good day. Thank you.